Hi, my name is Felix Fry.
And I'm Marco Rajnica.
We're here to find great trading opportunities that target 150 to 400% returns. And you? Well, you're going to help us do it every single day. So welcome. This is the Winning Picks Podcast. This podcast is for educational purposes only. OptionsGeek LLC is not a broker-dealer. OptionsGeek LLC, Felix Fry, and Marco Rajnica are not registered investment advisors. Keep in mind, options involve substantial risk and are not suitable for everyone. Please consult your own investment advisor before doing any trading. Make sure you read the full disclaimer at the end of this episode.
How's it going?
Hey, buddy, how are you?
Good. How are you?
Good. Almost the end of the week, huh?
Yes, sir. Got a cool report you sent me that I attached in the description down below so people can check it out.
Okay, great. I think it's important. It is a letter from Dan Loeb that was posted. Dan Loeb is the manager of Third Point, and Third Point is a very successful hedge fund. They are considered a shark. I consider him a shark. They are smart. They invest in all different asset classes. They invest in things like credit. They invest obviously in equities. They invest in private equity. They have a SPAC going on. They're just all around smart, very, very smart group of investors. And I think there's always something to learn from reading the articles they're posting or the investor letters they're posting. In this one in particular, I just thought, we could take a quick look at it.
Mm-hmm.
Share my screen. I think, what I wanted you to see was, if you go here, he talks a little bit about, I just thought it was interesting because relevant to what we could talk about today, but he gives his whole, let's just go to the beginning. He gives his whole thought process and, his returns for the funds that he has. 2020, they did well. He then talks about all the different things that he's thinking about on the economic front, pre-pandemic. He's talking about employment. I think one line item that I thought was interesting was he talks about consensus is strong. Here again, this favorable backdrop, because he talks about how things are good in general, but then he says inflation remains a chief concern. Consensus is strong that it will remain subdued given the high slack in the labor market, but if this is incorrect, the Fed will hike rates more quickly, shocking markets and challenging the recovery. We are focused on interest rates, which will help define how and what type of assets work at the margin going forward. The interaction between U.S. nominal yield, the U.S. real rate, and the effective difference between the two, e.g., example, inflation expectations, is our focus. Rising rates are not bad for equities, but can drive sector and factor rotation. We are looking to identify a rapid rise in rates or a decoupling of rates and inflation where the former rises, real rates rise and inflation, the latter, falls. This scenario would be bad for risk assets broadly and impact long duration assets more harshly as the discount rate inflects higher. Mm-hmm. Really important, I think a really important paragraph right there. He's giving you his roadmap. Right? We have a plan. We talk very much about a plan when we're using options. Well, one of the things that these guys, these large investors, hedge fund managers, institutional managers, is they build this roadmap. We're doing it on a micro level, right? Mm-hmm. We framework a chart. We're framing the way we're going to play the game, the options game. These guys are framing how they're going to invest, $30 billion. Okay. And this is a very, very important paragraph here because it gives you, he tries to, Dan Loeb he's paid to be long the market, but he's also paid to protect investors' money. And he's basically outlining, saying, like, look, if the Fed comes in to protect the market, protect against inflation. Okay. They could shock the markets and challenge the recovery. That's what he's worried about, right? And he's writing this at the end of 2020, and you start seeing what's happening here. So his worry is probably getting a little bit higher, if you will. He says he's focused on interest rates and what interest rates are doing. And right now, interest rates are trending higher. We can look at look at this. It's important to look at this TLT chart just as a barometer, but, interest rates go up, bonds go down, and look at a TLT. Interest rates up, bonds go down, and you can see how this is sort of trending lower. And, he's writing this right around here, and look what happens right at the beginning of the year. It's immediately, interest rates start increasing. Right. Which is a big concern of his and what he's looking out for. Now, when he's telling you he's looking out for interest rates, I can assure you that they have some sort of play on interest rates going up dramatically, right? Because he's telling you that if interest rates start going up, right, and they're going up with a high slack in the labor market, meaning you have this situation where interest rates are going up because inflation is starting to pop up, and why wouldn't it, right? There's so much money being poured into the system, and he's trying to tell you that if this comes into the bond market and interest rate starts going up, and it goes up too quickly, then the Fed is going to have to act quickly, because you have a situation where interest rates going up and a high slack in the labor market, which means job creation is not happening at the speed that government would like it to happen, which is a very it's not like you just create jobs and just say, okay, hey, we're going to pump in money and bam, corporations, you go bring in new job and create new jobs. That happens to an extent, but corporations are also, they're there to make money. And if they don't need new people and they can instead take some of the tax breaks or however the government's going to give and incentivize these corporations, they can appease the government by hiring some people, but then they're going to take that money and say, let's go get the bots and let's go get the robots to do whatever it is we need them to do, because at the end of the day, they're a better worker than the people we're hiring at $50,000 to $100,000 a year. So, this is a big risk that he's talking about, shocking the markets and challenging the recovery. So what he probably has some sort of structure where he has call options on rates, right? So call options or put options on bonds, whichever way you want to look at it. But he, Third Point is a firm that has a lot of bonds. In a crash, a firm like Third Point has been already probably shifting equity. They're shifting out of equities probably here a little bit, and they're waiting for this big move down so that they can get into, a situation where there's companies going bankrupt. And that's where they really shine. That's where there's a lot of money to be made over a period of 5-10 years, where they could buy the bonds and get into these companies that, good assets, they just got run over. Right. And so that's what they wait for. So this is a really, really important important paragraph. And I think going into what we talked about yesterday about how these guys are thinking, this is an important paragraph as well. Going into COVID, America's cash flow output, corporates and consumers, stood at a 70-year high, and COVID catalyzed a further surge to an outsized 17% of GDP. Okay, so basically, the cash flow for America was big, but then it was the COVID basically, he says it here, a substantial portion of the accumulated $2 trillion of excess savings among consumers should be unleashed as the economy reopens, favoring services sectors such as restaurants, travel, and leisure. Basically, everyone's at home, more people saving money, even people, if you think about in New York City, a person doesn't have to travel in, doesn't have to spend the money buying lunch and dinners in New York City. People are saving tens of thousands of dollars just on traveling and food in the city. Okay, so all of that money is being saved up, and there's anecdotes of people just saying, "I have all this money, I'm just going to go buy GME stock." Right? That's what a lot of people saying. I can lose it because I didn't go on vacation this year, and usually vacations in the United States for a family of four might cost $10,000. So these are the type of things that these managers are thinking, that when it opens, all the savings will come out. I'm sure he's also thinking that has this, some of that money will come out, but has this changed the psychology of the consumer where maybe they start saving more? And that's always a problem for the government, because the government our government, our economy needs people to spend. It needs people to borrow money to keep spending. Unfortunately, that's what's driving our economy for the last 20 years. So if everybody decides that they want to start saving more, because man, we really fell into a hole here, and we're out of jobs, or we're not working, and money's not coming into the households. People start thinking a different way. You might have changed the whole generation of thought here, where saving becomes something that people want to do. Excellent read. I'm telling you that you should find these investor letters of the big guys, the guys that put out. Bill Ackman is another one. David Einhorn is another one. They put out these investor letters, and you can learn. These are by themselves something that you can learn a tremendous amount. And I learn from them every time. I'm always looking at them, trying to understand and get into their thought. We talk about catching a shark. Like, we're actually trying to, at the heart of what we're doing is we're starting with UOA. And when you start with UOA, okay, yeah, it's nice. We're looking at certain trades, but at the end of the day, we are really trying to catch this guy, right? We really want to know what he's buying at that time. And if you understand the way they think, and the nuances start coming to you when you read their newsletters, and when you see what they're seeing, then you could start understanding, okay, this is what they're thinking. It's not coincidence that Dan Loeb, he's writing about this, massive amounts of savings that have this. It's literally trillions of dollars that people are sitting on, that are just waiting to go out and party or drink or go to the restaurants or go travel, go on a long vacation, because everybody needs it. God knows we all need it. And you then look at Melvin Capital's, we looked at it yesterday, Melvin Capital's portfolio. Again, he might have lost, money in GME, and the fund might have almost gotten blown up. It doesn't take it away from the fact that the guy's a great investor. He made a mistake there, and I think he's gonna, try to make that money back fairly quickly. But he's targeting Visa. 1, 2, and 3 were what? Visa. It was
Booking.
The
Booking and
was
MasterCard.
Yeah, and MasterCard. Was it bookings?
Expedia. Sorry, Expedia.
Expedia. Yeah,
I think it was Expedia. Yes,
so
yes.
Expedia. It was Visa, Expedia, and MasterCard were his top 3. That's really interesting for a $15 billion fund to say, I'm going to hyper focus right here. So, within that sort of thinking is, yeah, this economy is going to eventually open up. And when it does, boom, the floodgates of cash come out into the restaurants. I guess it's a timing play. Does everything collapse before that happens, or
Right.
What happens? So
now,
I think that. Go ahead.
Now that you mentioned that, and yesterday you were saying how we should learn from history, those different things. Does this look similar to the SPY you caught last year? It's right about a year now. It was a great catch.
Yeah, so interesting. Okay, so let's take a look at the SPYs. Well, I want us to take a good look at the TLT. So let's the TLT here. We're going to open this up a little bit first. We're going to talk about this because I think it's very interesting. We mentioned it yesterday. We're going to keep repeating it. This is something that people will talk about unless the market sells off hard here. It's something that people will talk about over the next 3-4 weeks. But you have here, this is TLT, and you see how it's been trending down, and starting from the beginning of the year, it's come off. Now we can take a look at SPY, and I'm going to go back a little bit further here. Sorry. Let me go back to 1 year and let's call it 4 months. Okay. So I need a little bit more time to show you something. 7 months. Okay. So we have something like this. Now I want to show you where we are. And last year, there was this story essentially about this virus that was coming out, that a virus was coming out, and it was, something that could be an epidemic, a pandemic, whatever they wanted to call it back then. But we were looking at the numbers, and we were sort of saying, this doesn't feel right, and we need to be long. The market had, prior to that, people forget, had this monster move. Okay, a monster move from, let's call it, because it really broke here. So let's call this move, let's erase this to show you something here. Okay. And we'll erase that. Just make it a little neater.
Mm-hmm.
Okay. So after it broke, it had this move where it's really from here to here. Okay. So we're talking about after, you see, there was this, looking at this here, it broke through because it had this dip, broke through in November to February. Now, it just so happens that this day, okay, we actually bought puts on the Friday. Things weren't trading well on the Friday. You know, this day here is essentially expiration, okay?
Mm-hmm.
February expiration, okay? Which is interesting, okay? Look at this run from November to December to January. You had some dip here. This was about a 3.5% dip. And then you had about a 6% jump back up. Okay. You see that?
Yep.
Okay. So we're here. I want you to look at what's just transpired. Okay. So November, we have this huge move up here because of the presidential election, but still November. We talk about from November all the way up here to February.
Mm-hmm.
You had this dip of 4%. Okay. And then you had this increase of about 7%. Okay. I mean, look, you can't make this stuff up. You know, we're at the exact same spot. It's also looking weak, and we're going right into February expiration. And it's a little scary. I don't know. I looked at it and I've been watching this and thinking, well, there's no coronavirus, so that can't be it. But I mean, can history repeat itself? It would be crazy if it did. And I'm not saying it's going to happen again like this, but I'm saying that, you know, even, you know, people forget that, you know, things happen. And this was a 3-4 month grind up. And this is also a 3-4 month grind up. And we're here. So the one thing that I told you yesterday was, you know, you have this SPY versus TLT that this will, if this stays where it is, so we have the market here. If the market stays up here or goes higher, and you got bonds trying to make its last, you know, the last dance at the corral here, you know, it looks like you can get a 140 print. It's not out of the realm of possibility. They just wake up one day and this is straight down.
Mm-hmm.
But at some point, you know, you get this down move from here and the up move in the equities, and you got the pension funds which have to rebalance. That can cause a lot of stock for sale and bonds to buy, just like it happened here, where on March 23rd, you know, this was massive. We're talking about a ridiculous amount of equities to buy, but this sharp move down caused the imbalance between bonds and equity. So the big pension funds, they have this 60-40 type of balance, and they try to adhere to that. Sometimes when there's big volatility, they may not jump in. I can tell you that it was a little odd. You see, in December, everybody thought that there would, because of such a big move since October, everybody thought that there would be an end of the month sell-off. JP Morgan had it pegged at maybe 100 billion for sale. It didn't look like that happened. Okay. And maybe they were waiting a quarter, or maybe they're just, you know, they were behind on equities, and the whole equities just kind of, you know, got back to normal here. But at some point, you know, you have this equities versus bonds trade that people will talk about. There'll be articles written, and it'll happen in the next 3 weeks. That's something to keep in mind. If you see that the market is heavy, or it's probably because people are shifting some of their assets, not because they think the market's going down, but just because. And will there be enough demand to hold the market up there? So you could see a 3 to 5% dip over the next 4 weeks, just because things are the big money who is just looking at the percentages, 60% in equities, 40% in bonds, now becomes 70% equities, you know, 35% bonds, and they're going to say, yeah, we got to get back. So we got to buy bonds and actually sell equities. One last thing I would say about that is that there's talk, and you can Google it, about how 60-40 is no longer valid because interest rates are so low. But when you start getting to that thinking, it's sort of like it's different this time, and maybe it's not always different. It's hard to catch this whole game-changing move of portfolio manager.
Right.
Okay.
And now that we're talking about SPY, I want to talk about this mentality of buying these SPY puts in a shorter period of time, multiple times. And I want to highlight Mark's comment here, what he said, and I want to get your comment on that. Do you see it on the screen?
Yeah. Okay. Yeah. So here's the thing about this. So at the end of the day, we definitely need, we need puts. We need something there to protect us, and you're forced to act. If you're going to play this game, you're forced to do that, because there's no, if we can't find a stock where there's put buying, and trust me when I tell you, for the last 8 months, it's very, very difficult to find a put buyer that has worked, puts that have worked. That, I'm passing on things every day, always looking back and saying, those didn't work. 9 out of 10 don't work because the market just keeps on grinding higher. The market is in control. The thing about what we're doing here is, again, I should probably create a video of all the times we bought puts and sort of the percentage returns that we got on these puts. We're treating every put, and lately, the last one I did a put spread, we're treating every put as a regular trade, as just another trade. And if you get stopped on that trade, it's likely that the market went up and the calls should have worked, which is what has transpired in general. If you've been in the game here for the last 3 months, then yes, it's almost like a token to the gods. So you throw that, you got to say, I got to do the right thing here, right, and have this put. If you get stopped out, you get stopped out. If you look at how we've been playing these puts over the last year, you'll see a pattern. You'll see that we obviously don't win on every put. However, we are attacking the market with these puts. I call it attacking because the market's grinding higher, and we're going to attack the market to try to catch that. We're trying to catch that drop. The market is pricing in these puts at a fairly cheap cost. Okay, when you see implied volatility of 13, it's basically telling you nobody wants the puts. Okay, which is really the time that you should start thinking about owning the puts. Okay, so if we lose on one, I mean, there was time in October, November, we lost on 4 out of 5, right? But the problem is or the good thing is on the 5th one, you catch a 5%, 6%, and everybody, takes home the 250 or higher. Some go up to 400% returns. That's what you're doing. You're basically trying to, as the market goes higher, call options are increasing. You should be taking off as the market goes out from the individual call options. For example, any one of these names that we have on, there's no way that people should have a full position on anything from 6 weeks ago because there's been markers to take off. So the game is about taking some off as it goes on, managing the last, trading around maybe the last part and trying to ride that trend. But also as the market goes up, to sort of establish a hedge that you can recoup, 200-300% on the way down, because you're going to lose 50% on 4 or 5 names, and you want to basically try to capture that. And then you end up in a position where, okay, you can end up about flat, maybe down a little bit, maybe you've made a little bit of money, but you've now, that's a wash, and now you restart and you get to reset some calls at a better base. Look at Walmart. Walmart is something that for some people was 100% takeout, meaning you could have got out of one. For some it wasn't, and it's fine either way. But the reality is, there's no way on the trade idea that we had that you should have still been in earnings without having taken some off the table. There's just no way that should have transpired. It had given you a 100% exit on the Walmart. It had come down, and then the earnings happens, and it's terrible. But the way I look at it is, I get to look at Walmart now down in the 130s and maybe let things happen and let things transpire, find a level where I think Walmart is still Walmart, probably dead money now because for a little bit of time, because they announced that revenues weren't going to be great for the next few years. That's never, good for an investor to say years, like, what are you telling us? So but this is how you play the game. It's, if you're wrong, you've lost the 50 cents, but you're hoping the stock collapse. So then maybe you can come back in and say, now I get to buy this stock, which has a decent story. They just messed up earnings and we can get back in at a better level. That's how you play the game. SPY, we were doing it when the SPY was, 180. I think we were doing it around 179 even. That, we're talking about 13, 14 days ago, the SPY was 370.
Mm-hmm.
So when it got to like 378, I believe it was somewhere around there, we were looking at these SPY put spreads. It jumped to 395. That's 17 points on the market. It's about 4 or 5%. Things have exploded higher. Let's reset with puts up here and have one that could take us down. Take us, bring us back up. Have a 150, 200%, 300% winner if it decides to make a 5% move down. That's how the game. That's essentially how the game is played. So I'm going to keep attacking the SPY, and if it goes up to 405, I think the market, frankly, if the market doesn't turn over here, the next target I'm looking at is like 402, 403. And if it hits 402, 403, I'm buying the 400s, and I'm trying to do something up there at the 400s. In the meantime, if something is being stopped, I'm trying to stop it out. I'm trying to make sure everyone is, hey, it's a stop. Keep it moving, because this thing, everybody wants to buy the dips, and the market is putting a little bit of pressure here on everyone. So I would just say, if you're stopped, you stop. It's a game of ebbs and flows, trying to find good risk reward, trying to be patient on the trading. The trading on all of these really occurs at the entry point. That's where the trading acumen happens. That's where the most successful people are who are using UOA are making the better money. It's that beginning part. That's really part. So, I've seen lately a market taker, meaning the market opens and someone just takes the market orders on a lot of the names that we're doing. I don't think that that's the right way to play it. And you're ruining the picture for a lot of people, and they're going to take your money. Frankly, they're going to take your money. So market order on 930, you're asking someone to, I would say to you, do me a favor, just go, give to charity, because you're literally giving money to, in this case, probably Citadel. So, that's not the way you play the game. It's not the way, I outline it in Winning Picks. And so it's, there's the trading part comes in that beginning part, the entry, patience, knowing that 95% of the time I'm going to be wrong on that price. I'm okay with marking it wherever I have, but 95% of the time I'm going to be wrong. So I would say that, I'm going to put out a video to show all the different times over the last year we've put the SPYs. And I can tell you, just because I know that the timing has been actually really good, meaning ultimately we get it. Ultimately we get our it just in SPYs. We're just looking at SPYs. It has worked out well for example, in February of last year, it worked out really well. In October, November, it was hurting us because we were wrong. I was wrong, 4 times. And then you hit 2 out of 3 where it's the market, you're catching these big drops. And that's how we're playing the game. So it's just important to understand that this is a probability game, and we have calls, we have puts. We're trying to lean long. We have been leaning long, but there's no way I can't have puts here.
And that's exactly what I was going to say. I learned it on myself because when you put out a put, I would get excited. I'm thinking, okay, this is where I make my money, this and that. But the reality is we're making money on our calls. With these SPY puts, we're actually just having a buffer in case the market goes down.
We're resetting, right? We started at 370. We went to 380. We made some money at 380 to back down to 365. We caught that. Then it went back to 378, 379. We reset there. Wrong there. It stops. It goes to 395. I wait a couple of days. Okay, I want to reset back at 390. So we're moving our hedge up while we're long these calls, while we're trying to get out of these calls. That's the game. That is the game. It's a constant resetting the bar to make sure that we're okay.
Cool. All right. Before we move into more things, I just want to hit the half an hour mark and tell everybody that we appreciate your support, and we want you to help us out even more by just sharing the podcast, because Felix is taking a lot of his time to actually do this, and we'll really appreciate it. me especially, because I'm here every day. But I think you guys are also here with us every day. You're our loyal viewers, and we really appreciate you. And we want to ask you for a favor to share the content, to share the podcast. If you have people on Twitter or Facebook you think might actually enjoy this, just drop the link of the latest episode. If they like it, they're gonna come on board. And yeah, that's pretty much it. Felix, do you have any words for people when it comes to this?
No, I believe I'm a different person, by the way, than I was when I was working on Wall Street, and we could talk about that. But I was, I think Wall Street creates that. It's, I had a me type of attitude, and I am a changed person over the course of the last kind of 20 years, where I sort of give more, hoping that the universe sort of gives it back. So I would just say that what we're doing here is incredibly valuable. And, I could say it and I could scream it over the ads all day long, but I'm in the weeds with, it's a dogfight. I'm in the weeds with a lot of people, putting out like, hey, do this, do that. I'm simply trying to talk from experience and give you valuable lessons, show you, lead you in the right direction of what to read, how to look at it. So I would just simply ask, as a favor to me, to drop a share, a like, and to allow these Google algorithms to kind of, help us out as well. And so it's all valuable.
Yes. And to add to that, we're actually looking, Felix is coming up with a lot of great tools, but we're just waiting to hit these marks of reaching more people. So it's actually worth putting out these tools for all of you that you can use and profit from. So yeah, cool. What do you say we move on to Zynga?
Let's get to Zynga. So Zynga is something we've talked about for a long time. It was a name that we were long calls. Some people are still long calls. I think the stock, when you see a convertible bond go up, and basically it's call options, and $700 million was spent buying these convertible bonds. I mean, that's an out of the money call option. Yes, it's 4 or 5 years, but it's a clue to tell you how high these hedge funds think a stock like Zynga can go. Mm-hmm. I also think that the world, the investing world, is looking for the next, social stock, if you will. The Pinterest is social, Facebook, Snap. That's all well known. Right. I got to tell you, Electronic Arts, ATVI, Take-Two, Zynga, all the Chinese ones, that you're talking about something very similar, where there's millions and millions, tens of millions, hundreds of millions of users, and they're just building those users up in that whole platform. You can monetize that in many different ways. And I think that these stocks they don't get the same love that, Snap gets or Pinterest gets, but at some point, and I think they're already advertising some of these things, but at some point, on these free games, you might have, what's Call of Duty, you might have them have a patch of like Coca-Cola on the back, or a patch like almost like race cars. Like they have race cars have the advertisements on the car. Well, if it's free, it's a free game, and your guy has a helmet, and the helmet has, his patches and whatever he likes, or advertisements. I mean, that's money, right? That's way to monetize. I don't know where that's going, but at the end of the day, they have hundreds and hundreds of millions of users, and the market likes that. It's hard to value over the long term what that could be. But things like Zynga, ATVI is a name that we like. All of these, they will do well over time.
And the esports trend is huge. It's becoming like a new sport, right? All these video games.
Absolutely, it's huge. Gary V, who I have on Instagram, I saw one of the videos he had. He basically said, why couldn't he invested? He actually invested in an esports group, and Nice. He basically said, why couldn't this esport team that I invested in, who they're really good, they win all the championships, why couldn't that be as highly valued as the New York Jets? The Jets are awful, so and they're worth billions of dollars because they're New York. But if you own the franchise, the esports team, why couldn't it be? I mean, at the end of the day, you have hundreds of millions of people around the world watching these young kids play games, and they're superstars. Sounds like, in football is just America's pastime. It's been there for 100 years, but maybe this is the new beginning of the next 100 years, where people are gamers, and gamers are the new Hall of Famers, if you will.
Right. Okay? And these kids growing up today, they're going to have expendable income in 10, 20 years. They're going to be spending their money on that.
Right.
And they love video games.
Right.
So, it's the future.
That's right. So Zynga's popped up here today. The stock continues to trade well. They had an earnings. It was a small blip. The stock has picked up back at $11. It's look at this staircase going up here. I mean, they're buying February. This is Friday, but let's look here. The March 12s looks like maybe it could be somebody getting out here. We'd have to look at this, but you see the open interest 10, 11, 12, 13. They're looking into the 14s. The April 14 calls here. Again, it's active on the call side. You're looking at if you're talking about ZNGA, let's say 17, right? 17, 18 out to April, 17, 18 out to April. $17, $18 out to April. I just want to go back in time. And let's use 5 years just to see again.
Okay.
So, wow.
Wow.
We gotta go back 10 years. We got to go back 10 years. Is that right? Just want to see. I want to catch where. Okay. So, I mean, look at this climb it's doing. It's, this was a hot, when ZNGA came out, it was pretty hot. This was the whole Facebook. They had the Farmville and then Facebook let them go. And then they spent years just developing users and developing games. They've made a couple of big purchases. They bought a few companies, a few products, and they're off and running here back to where it was before. You had these big convertible bonds, big call options. So some people might be taking, they might turn it into the people who buy convertible bonds sometimes because it's an option. They, some of them are volatility traders. So there's an element of selling stock as the stock goes up. But, I think it won't be, I'm not sure this would be a 12 to like a very fast, quick move. It could be, but I suspect that because there's these convertible bonds, and from the convertible bonds, people sell calls or they could sell stock against what they own already to lock in some profits. I think that, once you start getting 12, 13, 14, it could be a steady kind of growth name. But I like it. I mean, I've always liked this name, and I still like it. I think as much as I like ATVI and then I like ZNGA, I like all of these names because, again, it's the users, and over time, the market likes that. The market likes if you're growing revenue. If you're actually growing revenues, that's great. But if you're growing the user base and you're in the hot trends and you're doing it's good management and management's open with what they're doing, it's hard to beat these types of names. Cool. But so that's what I would say about ZNGA. So 16, 17, 18 seems like a stretch, but I think if we look at 16 here, that looks like what it's trying to target this range right here first. 16. So you might see over the next 3 months, maybe the next earnings and move up to 16, 17, which is about where it's asking. But, I would say, I wouldn't say it's going to be like a rocket ship. That's what I would say.
Okay. Fair enough.
How about the one that I saw here was the KHC.
Okay.
So I like this one. I like KHC. I don't like reaching here. I think it's, it's one of these where it's like, this definitely made my list here. We talked about we just saw the Dan Loeb article. We talked about inflation. Well, these guys just basically said, I don't know if people on this podcast look at their grocery bill for the month. I tend to look at it just to see what's going on. I can't believe how much it's grown. I honestly, I'm like, did my wife just like somehow change the name of what being charged to like something to like Saks or something? Like I can't understand. Like, what are we buying? Like what I've never even understood it. Now I haven't done grocery shopping in years, but you walk in there and it's like, I'm looking at Frosted Flakes. I have Frosted Flakes in the morning. I'm like $10 for like, I used to buy Frosted Flakes for like $1. I'm like $10. I don't want to eat. I'm trying to understand what the hell we're buying. And then all of a sudden I'm reading all these articles about food inflation and it's incredible. And you're reading stories about the companies. You saw producer price index go up. So the companies, they're not going to eat all of that. They're going to they're going to pass those prices on to the consumer. And that's what they're saying, which right? You're hearing what the companies are saying. They're going to pass the price to the consumer. The consumer is already hurting. So the consumer is now going to have more expenses each month. $1,400 is going to get us nowhere. When someone gives you $1,400, you have a family of four, you live in New York, I can tell you that eats up the whole 1 month. It's like family of four. If you have kids that eat a lot, you're teenagers, forget it. I mean, you're talking about eating up a month and a half. That's just food. That's not even lights and your cell phone or whatever. So it's incredible to see what's happening. But you talk about what Dan Loeb is scared of, and then you hear KHC say that Kraft Heinz say that they're going to pass on food pricing or food costs to the consumer, and you got this move up here. I like this. I mean, to me, this is a good story on a beaten down stock. Warren Buffett's in the name too. This is interesting to me. This has made my list. I'm kind of hoping that you get a pullback here, but this is something where you're seeing guys buy calls here. There's another name, Michael Burry has gotten into the name. So smart guy. He hit the GameStop. He was in the Big Short. Big name and made $1 billion with the market in CDS. But when you're looking at the call buying, this is 3x6. I'm not sure this could be. Let's take a look at this for a second. So this is the 40 calls. Let's just go down here. So we're trying to isolate a buyer. 61.57 here. Implied vol 30.20. This actually looks like it might have been a seller. So, and small spreads there, but I'm concerned that 500. So 500, 120, 1249. I'm concerned that perhaps when I see something like 362, I'm concerned that there might be a spread in there, or somebody bought the, first of all, KHC doesn't trade like an internet stock. So, you're talking about, this is a large move for KHC, but you see this gap here from 43 down to 30. This was a big move from 2 years ago. And we just passed this, which was, let's bring this back to a day, and let's bring it back to, this is 10 years. So it's hard to really tell you're looking at something like this here. We see that this is clear. Okay. This is clear. So 29 to 35 and a half, call it 20 and a half. Fine. We can even go down here. 20 and a half to 35 and a half is $7. So 7 plus 35 and a half is 42 and a half. So 42 and a half is something that, seems like it could easily get there. And then if you look, we went back, what did we say it was? That big gap, 43. So you remember seeing that? 43. So we just did in the options 42 and a half, or framed it to be 42 and a half. And if we look at 10 years, just to get it back, 10 years. No, I want to get 10 years. Sorry. Didn't look like 10 years. We said 42, 43. Turns out that's exactly where it looks like it's going. So you could just with a little bit of technical analysis, we kind of have reached the same conclusion that 42, 43 sort of is the next stop or where it wants to go. I would love, it just went from 32 to 39. I would love to see him move back towards, what level do you think? 35, 36. Yeah. I mean, I would love to see that. That would make a lot more sense to that's going to make a lot more sense to buy it here. So again, this is how you look at these things, right? Do you want to reach here? The stock just went from 32 to 39. It's difficult. So coming down to 36, 37, you might want to start nibbling here because it is showing, this is a name, Buffett's in this name. So it's a value name. But if they're passing along these price increases and things are going up, it's people are concerned about margin pressure. They're not going to take that. They're going to say, no, we're going to make sure our margins are okay. And the consumer's going to have to pay more.
Right.
Okay, and consumers have to eat, and you have this
It's
elasticity
necessity.
of
Right.
demand. So
Right.
yeah, inelasticity. So
Mhm.
so that's KHC. I think it's interesting. Good story, good backdrop. So that's that.
Cool.
There's continues to be, we looked at this one. Did you see this one today? The pen.
Penn. Yeah. 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 It was far
Okay,
out somewhere. Where
we
was it?
a little bit further out. Yeah. So we have pen. And we spoke about Penn. We spoke about how there was basically, it looked like there might have been a call buyer or and selling stock, or it looks like people were right around this level only
Yeah.
last week, where they were moving things around, right? They were saying, you know what, maybe Penn's had a big move. Remember, people were shorting the stock at 30 now. I think that was obviously
Right.
dead wrong. But this guy David Portney is frankly, I'm on the record saying he's a genius. I think his ability to create content online it's genius level. And right now you're seeing, this 95, 150 collar, right? So this is buying the 95s, okay, and selling these 150s, okay? Now
Mhm.
you can see that the spreads, you can see how there are spreads there. Okay, so you see these spreads, so you know that they're trading together,
Okay.
and that's what you do. It's called a collar, buying the puts, 6,000, buying the puts, selling the calls, different strikes. So between 95 and 150, he's going to make money, and he didn't pay anything for it really.
Right. Right.
$12 and $12. So he does it for free. He's willing to, maybe he's selling some stock. Usually you would do this if, again, let's think about it. You own a couple million shares of stock, and you're going to be putting a little bit of pressure on Penn because you're going to sell, 500,000 shares or 1 million shares. You could make money if the stock actually doesn't hold and it goes down to 100, or it drops 15%, or the market's coming off a little bit. You can make $3-4 on this spread, and 6,000 times it's $2 million. So that's the power of being large in a name and saying, well, we're going to get out of 35% of our pen position, or whatever it is, because it's, we've already made $60 or whatever we've made, and so I want to get out of 1/3, or even maybe get out of half, whatever the number is. If you know that, right, and you work at, let's call it BlackRock, right, and really the way it works is they get no longer slips. It used to be you get a slip of paper, a note saying get out of it, but now it's all in the computers, and the portfolio manager says, take out 50% of Penn and do it by the end of, let's say the end of the first quarter. I want to be out of Penn. And so, the person who's doing this type of trade is saying, okay, well, where would you sell more? Where would you get out of the whole thing? If it got up to, the instructions are, if it gets up to 135, 140, get out of everything. So, you know where the portfolio is directing you. The portfolio manager is directing you on getting out. And so if it was me, and my job is to try to extract some profits from all this trading that we're doing, so much volume in the stock, then I would do something like this to basically say, okay, it is kind of toppy. Technically, it looks like it can get down to even $90. It looks like it can hit. And if I can just do this type of trade, I literally can make, if it gets down to 90, you're going to make a lot more. Could make $6 million on that trade. So this is how the trader at BlackRock, this is how he proves his value. You see what the portfolio is doing, what we want to do, structure something that we can make a little bit of money just in case the thing turns. Okay.
Cool.
So this is a signal. This is a signal that someone is potentially about to sell or start selling Penn. We also saw the same thing last week. So it's twice in a period of 7 days where we're talking about Penn, and we're talking about a situation where people are, it's seemingly looking like they're selling, or they're at the very least they're hedging, but they do those types of trades when they are starting to sell, because it's not really the portfolio manager. That trade is being done by a trader, and that trader's sole job is to make money off of the flow they're doing. Okay. So when we're seeing that, this is something to think about and look at.
Cool.
What else do you see?
Well, SWBI. Sorry, SWBI.
SWBI.
It was another one
stock is
accidentally.
okay. So this is interesting. This is an interesting one. Smith and Messon, Smith and Wesson. I'm gonna make some memes on all the mistakes I made. Smith and Wesson guns. Okay, there's a lot of talk in the news about Biden and what he's going to do with guns and how he's going to fight against the gun industry. One thing that is interesting is that this stock, let's say that doesn't work and he loses his bid to halt, or what he wants to do is, they're fighting against the Second Amendment. Like Trump was battling the NRA. There's a big story. So you can go look in the news about the big story. Okay. But at the end of the day, the manufacturers, they don't have, they can't get sued if someone goes and kills someone. And because they used a Smith & Wesson gun, you can now go and sue the Smith & Wesson manufacturers. They have immunity. You can't, they're just a manufacturer gun. They're not the one that's actually pulling the trigger. He wants to make it so that he lists that immunity. And that might put Smith & Wesson out of business in 3 weeks, right? The first murder that happens, you have literally 500 lawyers put class action lawsuits up and say, anybody who's been murdered in the last 10 years, come into this class action, we're gonna go and get Smith & Wesson for all the people that have died because murderers have used Smith & Wesson's guns. That's not going to work for Smith & Wesson. Stock is going to get drilled and stock is going to get smoked. However, somebody's buying calls here. I don't know why. I don't know if they're short the stock, but Biden is talking a tough game against the gun industry. And I think it's something to watch. I think it's super interesting when I look at this and I think they're coming after these. Smith & Wesson is, if you just look at it fundamentally today and what the amount of money they're producing, it's cheap. But, like I always tell people, if you had a restaurant, you owned a restaurant, it's producing $1 million a year, great restaurant, you're doing well, and you want to sell it, you're not going to take $1 million a year. Your restaurant is valued at, say, 10 million, some X of, of $1 million, right? And, I will pay you 10X because I believe that you're going to produce $1 million, or I'm going to produce $1 million each year for the next forever, right? And maybe it grows, maybe it doesn't, but I'll get my money back and I'll produce. That's how you buy a company. Well, if you were going to buy Smith & Wesson, this company looks amazing today. It looks amazing over the last couple of years, but if it's not going to be able to produce, or it's going to have these lawsuits against it, then it's not going to produce and it's not going to look like the company it looks like today. And it's going to get eaten up with legal costs and liabilities. And that is not good for the future of Smith & Wesson. So you have this big situation where, does it make it or does it not? Is Biden blowing smoke up everybody's behind, or is he really going to go after them? There's a lot of promises made by politicians. Do they follow through? Is it worth the hassle? Does it cause a revolution? Does he really want to go after the whole gun industry? And, remember, you still have half the US not on his side. And that half happens to be big supporters of the gun industry. So what do? Do you just talk through it and then say, push it to the side and nothing gets done? Then the stock explodes. The stock, this thing's 22 and a half. The stock is cheap if that happens, but 22 and a half is thinking somewhere around 28, 27, 28, Smith & Wesson.
It's a pretty steep jump.
It's huge. It's a huge jump. But again, it's a cheap. I'm telling you, this is a really cheap stock, really cheap. So it's one of those things like if this is not going to work, this stock is going through the moon. And we had bought calls on this one. But, if that's the thinking, it's sort of, if Trump would have won, then perhaps that was the key to take it all the way up. But there's never been more guns being sold in the United States, right? You can't buy it. The demand is still so high. People are buying guns right now, because they think that it might go away, or their ability to buy guns, will go away. So it's just, there's never been more guns being bought in the United States ever before. The problem is, will that continue? I don't know.
Right.
That's somebody buying that it's interesting. Um, if you can tell me what Biden's going to do, I can tell you that it's either going to get crushed or it's not. So it becomes it's a binary type of play. And frankly, March is not that much time. I don't know what the play is there, but it is interesting because it's this whole gun thing is looking binary. This stock is dirt cheap if it doesn't go through, like dirt cheap. It'll trade 30. The idea was when we were buying it 30, 35, it could easily trade that, but on fundamentals. But if it's not and they have these issues, then it's going to trade at 5, 6.
Right.
Okay. So keep that in mind. So
Cool.
that's good. Why don't we take a question? Or
yeah, now before we circle back, I just want to remind everybody, if you're subscribed, you can also hit the bell notification. So every time we go live, you can actually get to see that and then click in and not miss any part of the podcast. Now, my question is, let's circle back to crashes a little bit from the beginning of the episode. Since you've been through the 1999 crash on Wall Street, 2008, I wanted to ask you, how Felix back then, what were you doing? What were people doing? Where were you at the time? Things like that.
The first crash wasn't so good. I learned my lesson after the first crash. The first crash. So I made so much money as a young kid trading options in 1998, 99, leading up to 2000. It was cab drivers were making $10,000 a day, literally. And, I was making a lot more than that per day. And by 2000, in 2000, I was never, I started Wall Street in 1995, I didn't really catch my groove until about 2000, 2002. And I really started becoming, call it a player in equity derivatives. Call it luck too. I mean, there's a lot of luck in my career, because think about this. When I first started in 1995, there was only 150 million options trading for the year. 150 million trading a year in 1995. We are trading 7 billion, annual rate 7 billion in now. So what traded in a year in 1995 trades in 1 week today. 1 week to 1 year. So this explosion of, talk about just being lucky in life in general. I feel blessed that I was part. I can go into a whole story how I got to start. It's completely the way I landed in options and in Chicago. And as a young kid, I was so young. I didn't really even know how I got there, but I got there, and it just so happened that the options industry exploded. Okay, it just exploded, and I was a part of it, and I was at the heart of it. Because I was working at a top investment bank, I had gotten the best education in options, and I was speaking to guys I read about in the book. So I was trading a lot of options, and I was actually selling options. I was going on the sales side, and then I was also trading, in my personal account, and so was everybody else, because it was 1998, 99, 2000, and everybody's making a lot of money. The market crashed, and I can tell you the day the market crashed, it was, I think it was sometime in April. It's the first March, April. So it's just like this. It was like, what happened? I mean, it was the Fed started talking about interest rates and made it like a little comment. They're like, hey, maybe this is getting a little bit crazy. Right. And it just so happens when everybody was long. I mean, it just felt like a disaster. I can tell you at 26, I think I was down just by 9 o'clock in the morning. I was probably down at $500,000. And I still had to do my job. It's like 8:30 in the morning, and I'm down $500,000, and I'm like, doesn't feel so good on the way down. It's like, whoa, just sweating, but I wasn't the only one. There was a lot of people, remember stocks were going up $100, a day, it was like going from 200 to 300. So it was just an interesting time. And, when you take a hit like that, it did something to me a little bit, it was the first time I'd taken such a big loss personally, just in like person, with time, you get numb to that, to those levels. And so I can tell you for the next year and a half, buying the dip and sort of looking for that big move cost me a significant amount of money in the next I would say call it 12 months. So it was my first big lesson in how to handle sort of, making these massive gains. And then, by the way, almost forgetting about taxes, right? Because you get there to the end and you're like, oh, by the way, that's a big loss. So these are lessons I was learning as a 26-year-old kid. I was in sales, and then, to this day, I'm probably the only person maybe ever in the equity derivatives group, to go from being a senior. I became a top salesman on the street, to not jumping ship, to jumping the other side of the aisle, because usually it was sales and trading. And I jumped to the other side and became a senior trader overnight. It was one of the first. I don't think anybody's ever done it. What has happened is you get a lot of credit for being a trader, being smart as a trader, and the traders would jump over to the sales side. There was a lot of that going that way, one way, but sales to trading, I don't think it's ever been done. I think I'm, to this day, at a top investment bank, I think I'm the only one to have ever done that. And do it at a high level, not just, oh, I'm going to now go over there and learn, and I'm part of this group, or I spent 2 years there. And I'm talking about, I was one of the top derivative advisors, if you will, salespeople, sales traders in equity derivatives, listed equity derivatives. And then overnight, I jumped into a trading position where it was like, here's a big book. You have billions of dollars in capital. Make sure you don't mess up. Okay. The only reason I got I got the bullpen call, like, right, we need the righty, come on in. Because that day, I think it was 5 to 7 traders walked out the door. They literally got up, they got their bonuses were a few $1,000,000, and they were like, okay, thank you very much. And they walked out to go to a hedge fund and start their own hedge fund. And so we're running a business. We're running $1 billion business at the time. I have clients, and I'm on the phone, and I'm like, 7 guys just left. I'm telling the boss, like, what are we going to do? The big boss. So the big boss liked me. He was from Queens. I was from Queens, and I was scrappy, and he liked me. He gave me a lot of rope to succeed. And I convinced him. I said, I can do that job. I'll jump over and do it. And he was nervous about a lot of things, and I took that role on, and that's how I jumped sides. And then that was a few years, and then I jumped over to the buy side, and that was the next journey. And I had to learn a lot there. And the crash, there was more prepared. There, I was the one telling people it's going to crash. There is no doubt in my mind. And even knowing that it was going to crash, knowing and fully prepared, they changed the rules on you, and they messed things up, and it's not as easy as, I'm long puts and everything. I'm short everything, every bank in the world. I think I still probably have it somewhere. I was writing articles about Lehman and Bear Stearns when they were at the highs. Before anybody was shorting these things, I was out there saying, I looked at it 100 different ways. I was looking inside and I'm not an analyst. I'm not a trained fundamental analyst, but I know enough. I can look through the balance sheets and start figuring things out. And I just thought that there's something could be really wrong here, and there could be a run on the bank what I was thinking was, if there's this thought that Bear Stearns can go down or Lehman go down, then all the hedge funds who have their money there, parking it as prime brokerage, and they pull their money, what could happen then? And I started thinking about it and pushing, puts, and I'm long puts, but they changed the rules, and then, you get hurt on the way up. By the time it crashes, you don't have the same position I had, 3 months earlier. And so, that's the game. The game is, not trying to be too big at any one time. You might be right, and you still might lose a lot of money, or you might not make as much money as you can. So that was a lesson that I learned there about sort of sizing, and I had it cornered. I literally had it cornered. The fund that year did very, very well until December. What a disaster that year, because we did very, very well, and then we were making what would be considered the smart move, which we were moving out of equities. So we had moved out of equities perfectly. We didn't take the losses that the whole street was taking. We were like, this is great. And then we jumped into the bond market. So that's why I tell you, I understand how to, when you're taking money out of equities and into bonds. So our hedge fund is saying, all right, we're going to get into it's called the distressed market, right? Because the equity market's down, the bond market, there's no bid. And this is, we're looking at situations where bonds are just being thrown out the window. So we started buying bonds. Okay. Started buying bonds of companies and thinking, okay, this is the trade. And, again, you're playing a portfolio of bonds, 1 or 2 hurt, but 8 do okay over the course of 5-10 years. And we're trying to buy strong bonds. It's, it'll be good. Well, again, liquidity, you buy a bond one day and then, there's still a lot of bonds for sale. So you're never going to catch that low. And so we were getting marked every day because the bond market continued to crash with the financial crash. Bonds are getting marked down to nothing because people were just selling them. So again, the fundamentals don't matter when there's a lot of selling or there's a lot of buying. Just like right now, it's the flip. A lot of buying, fundamentals don't matter. Well, when they're selling, fundamentals also don't matter, right? You buy something because it's so cheap, it could still get cut in half. And that's what happened in 2008-9. So that was a big lesson on marks, on understanding, again, psychology of the way things work and how, you always need some dry powder. You always need to have some, longs and shorts and try to play it the right way because you just never know when you wake up where, something bad could happen. The flash crash is another perfect one, right? You just wake up and it just happened. You're talking about it's just like the market's trading low, and then at 230, boom, flash crash. And what happens? If you have an account and you're long stocks or you're over leveraged, they take you out. They clean you up, and then you're the low, and then it goes back, and then you just literally ask yourself what happened. And by the way, there's no bid offer in those moments. That's what people don't understand. They think, especially when you're selling options, just like, just get out if the market starts going against me. In those times when the market goes completely against you, there is no bid offer. It's one bid at 20. What do you want to do? And then, TD Ameritrade says market orders, take this, market orders, get it out. And there you go. You get the best bid. You think Citadel is going to give you the best price there? They're going to give you the best price because there is no price. Their best price might rip you off for $2, $3, $4. You have a 10 lot. That's a lot of money, $2,000, $3,000, $4,000 per trade. So, a lot of lessons. And yeah, I mean, the crashes, it's different when you're at the bank. There's a lot of people around you. So you're feeling the energy of a lot of people. When you're at the hedge fund, there's not that many people. I had my office, I'm sitting next to, the bosses. We have offices with the analysts. It's quieter. It's a lot different. If someone's yelling, you could hear it from over there. In the investment bank, it's, it can get, back then it used to get rowdy. Now it's like silence. Everything's on the computers. Back then there was a lot more, people climb over the table and be like, start tackling each other, it's like, and then afterwards everybody's getting a beer. But, it was, I would say if you really want to understand that when I first got in 1995, and it was even crazier in 1987. So you ask the old timers, which I always love to do. I always like talking to the old timers. I know that in like the 1987 crash, just look at the pits, just go back and look at documentary and you see people screaming, and that's how it was. And you look at The Big Short and you see the opening scenes, and he's talking about, and he's, he goes to work at a Wall Street firm and people screaming, yelling. That's the way it was. That was the environment that I grew up in. He was talking like 87, in the 90s, but it wasn't far-fetched from that, back in 1995 to 2003, a lot of screaming and yelling and going back and forth. And so I thrived in that environment in the investment bank. I didn't really make a lot of friends, to be honest. I wasn't, I was there to make money. I was there to, and it takes a little bit out of you. It's animal spirits in those things, trying to be in a corporate environment, but everybody's out there to make money. So, it was, look, I learned a lot of lessons, and it's very different parts of, where I was in investment banking, young, and then I had that experience, and I went to the hedge fund, wiser, if you will, but a different type of experience. And now this experience feels very, very scary for what could happen. We experienced coronavirus, but that happened in a few weeks, where it was just like straight down. The hard part is going to be when this economy slows down maybe a little bit, or meaning things are not going to be as bullish, and it's the ups and downs for 18 months. That's the real test.
Right.
That is the real test. When you go through 18 months of down 20%, up 20%, down 15. That's what happened. Just go look at the NASDAQ crash and go look at the way the market chopped up and down, and you'll see down 20, up 20, down 15, up 15, down 25, and then just a trickle down for 6 months. Just like it's trickling up every day, it trickles down for 6 months. Those things are not so, they're just not a good feeling. So, any other questions?
Great story. I love it.
Look at the board.
Yeah,
I feel like I'm boring people, but yeah, let's see.
We love it.
Could you tell us what you studied? Yeah, I studied. I grew up in Queens, New York. I studied at the what do you call it? The School of Hard Knocks. But then I went to Wharton. I studied finance, economics. I had a math minor. I was always good at math. Comprehension for me was always difficult, so I had to put a lot of effort in reading, and I didn't like English classes, but I studied I studied finance, economics at the Wharton School, and then I can tell you, succeeding at Wall Street takes not just intelligence, but it takes, especially in the trading and the trading floors, being on a trade floor, it takes street smarts. Some of the best traders have very good street smarts too. People talk about, sales and trading. Some of the best salespeople are traders. Some of the best salespeople are hedge fund managers, right? Selling is part of the game. You're selling your ideas. You're selling the story, right? What do you think people on Reddit are doing? They're selling a story. Whatever that story is, everybody's out there selling their story. The better you are at it, you could be a good hedge fund manager.
Cool. Great.
All right.
Thank you, Felix. We need more Felix stories, that's for sure.
Good. Yeah, just ask me. You can be more direct. You can just ask me. I can talk all day. I mean, we talk about the aspects of getting into work. I can go all day. The good managers, the bad managers, the ones that, the corporate culture, the good part of it, the bad part, all the places I worked, lessons I learned. I can go on for days, but it's not UOA. So, we can go over a little bit. It's 15 minutes. Okay, goodbye.
Perfect. Thank you, Felix. Bye. And thank you, everybody. Make sure you like, share, and subscribe. All right. Have a good one. See you on Monday.
Be good. Okay.